70% of your credit score comes from your payment history. Here is how you can improve it fast. Hi, I'm Alex, and today I'm going to show you 5 ways you can help get your credit scores up in just a few weeks, and I'll tell you how to keep it that way. I'm all about getting the most for your money, so let's talk about some of the best ways to improve your credit score that will also save you money too. If you're new to this channel, a warm welcome, and hopefully you'll find answers about credit cards, saving money, growing your income, investing, and saving for retirement. So without further ado, let's dive in. If you want a higher credit score, following these 5 steps can help. Number 1, pay your bills on time. Now guys, you've got a credit score. You know you should care about it, but you really don't. So what? It doesn't affect your life that much, right? Well, wrong. Credit scores have an almost lifelong impact on your job and salary prospects, not to mention the cost of borrowing money on or off of credit for other things like buying a home or car. At the same time, most people don't know enough about how their personal finances actually work to take advantage of this information and all its benefits associated with a high score. So guys, let's start with the elephant in the room. What is considered a good credit? Well, a good credit score is generally anything above 720. A bad credit score is usually anything below 620. Your score will get there over time as long as you have multiple credit lines open and you stay on top of your payments. A FICO credit score is determined based on 5 distinct factors and used by almost 90% of top lenders. Payment history has a weight of 35%, credit usage about 30%, age of credit accounts about 15%, credit mix 10%, new credit inquiries about 10%. You can see that your payment history is the most influential factor in your credit score. As a result, it's better to keep your old student loans, for example, on your record when you pay them off. Keeping your debts current and paying them on time will work in your favor. Make sure to pay more than just the minimum payments each month if you have the funds available. Keeping your credit utilization rate low can have a significant effect on your credit score by reducing the amount of revolving debt you have. Depending on the creditor, some report as soon as the payment has been made, others report monthly. Your statement balance is usually reported to credit bureaus monthly by credit card companies, but this may vary depending on your issuer. Your card issuer will be able to let you know when it reports balances to the bureaus by telephone or even online chat. Your monthly balance should be paid off as soon as possible. Throughout the month, you can also make multiple payments to your balance, make it easier to actually keep track of your spending and keeping your balance low. Paying off even a portion of your debt will have a positive impact on your score, but paying off the entire balance has the strongest and fastest impact. Number 2, have a low balance on your credit card. You should aim for 30% credit utilization or less. At any given time, credit utilization refers to how much of your credit limit you are using. In FICO credit score calculations, it ranks second after payment history. Paying off your credit card balances in full every month is the easiest way to maintain a low credit utilization rate. Let's say with a credit limit of $50,000 and a $10,000 charge on your credit card, your credit utilization is 20%. Using your statement balance is how credit bureaus actually calculate your utilization. So even if you pay off your balance every month, you still have this kind of utilization. In the event you cannot achieve that, you should keep your outstanding balance to 30% or less of your total credit limit. The goal actually here is to get this to 10% or less, which is considered ideal for improving your credit score. The less you pay towards credit cards, the more you are likely to accrue balances that can actually damage your credit. With a flight of balances and no payment history, a lender might overlook your financial status altogether. If there are a number of open balance interest-bearing accounts with high balances, an inquiry could ding your score in the short term. You can also increase your credit limit to improve your credit utilization rate. If you do not increase your balance together with your raise, getting a higher credit limit may improve your credit utilization. Online credit limit increases are generally available from most credit card companies. You need to submit an updated statement to verify your household income. A higher limit can be approved in less than a minute. However, it can be increased over the phone as well. If you can get a higher credit limit, paying off your balances in full is still the best option for maintaining a low credit utilization rate. Number 3. Don't make too many inquiries about your own credit. Guys, taking out new credit can harm your credit score, so wait a little while before applying for it. Inquiries and accounts average ages are minor scoring factors, but you still need to be cautious when applying. A few exceptions to this rule include when you shop for a mortgage or auto loan. Some credit scoring models may overlook some inquiries if they occur within 2 weeks, since rate shopping isn't risky behavior. Your credit history can be accessed in 2 ways, sometimes referred to as hard inquiries and soft inquiries. Now, soft inquiries may include internal checks of your credit checks performed by a potential employer, or credit checks performed by a financial institution with which you already do business. Credit card companies might also perform a soft inquiry to determine whether to provide you with pre-approved credit offers. There is no effect on your credit score from soft inquiries. You can, however, suffer from as long as 2 years after a hard inquiry. Now, an application for a new credit card, mortgage, auto loan, or other forms of credit is considered a hard inquiry. It's unlikely that the occasional hard inquiry will have much of an impact. However, if you incur many in a short time, your credit score may suffer. If you need money, banks may assume that you are in a tough financial situation and therefore riskier. Credit bureaus are notorious for not giving credit to people who need it. Take the example of someone who needs money after filing for bankruptcy and has a low credit score. They are only approved for loans with high interest rates that can put them in more debt than before. Number 4. Keep the length of your credit history long. Guys, your credit score includes the age of your credit accounts. Lenders are more likely to view you favorably if your average credit age is older. It's a good idea not to close old credit accounts you are not using. Credit history associated with these accounts would remain on your credit history, but closing these accounts while you have a balance on another card would reduce your available credit and increase your credit utilization rate. This could result in a few points being deducted from your score. You should be aware that closing credit cards can slow down the process of improving your credit profile. When you close a credit card, you lose its credit limit when your score is calculated based on your credit utilization. You should use the card occasionally to avoid the issuer closing it. Make sure you take action if your account is delinquent, charged off, or in collection. If you've missed or been short on multiple payments, for example, work out a plan to pay the past due amount before you move out to future payments. Your payment history won't improve significantly after making that change, but it can make up for the late payments. You should decide whether it makes financial sense to pay off charge-offs and collections in full, or to offer a settlement to the creditor. In the newer FICO and VantageScore credit scoring models, paid collection accounts are not treated as negatively as they used to be. Make sure to get a pay for delete letter before paying these collection accounts. Now guys, a pay for delete agreement states that you will pay the debt if the collection company deletes the account from your record. Often you will be asked to pay in full if you wish them to remove your account from your credit report. You might be able to raise your score a little bit by paying off collections or these charge-offs. Bankruptcies can create a negative mark on your credit history for 10 years. Negative account information can remain on your report for up to 7 years. Number 5. Be aware of which type of records you have on file with the 3 major bureaus and work to correct inaccurate information. So it helps to understand what might work to your advantage or against you when it comes to improving your credit score. Checking your credit history can help you with that. Get a copy of your credit reports from each of the major national credit reporting agencies, Equifax, Experian, and TransUnion. On the official annualcreditreport.com website, you can perform that once a year for free. Next, look at each report to determine what's helping or hurting your score. Higher credit scores are largely influenced by the history of on-time payments, low credit card balances, a mix of credit card and loan accounts, all credit accounts, and minimal inquiry activity. Defaulting on payments, having high credit card balances, judgments, and collections harm your credit rating. As of 2021, the national average credit score is 711, and depending on your age and what you are looking for, it could be the difference between qualifying for a mortgage or being able to land a new job. Poor credit history is often from information that is out of date or incorrect. The best thing you can do to help maintain a healthy credit score is by checking your free annual reports from the three major bureaus, Equifax, Experian, and TransUnion, and make corrections where necessary. Rebuilding your credit doesn't have a set timeline. Credit scores increase over time depending on what damages your credit and how you work to rebuild it. Bringing your account current and making one-time payments could be enough to rebuild your score even if your credit score takes a hit from one missed payment. On the other hand, if you miss multiple payments and you fall behind for over 90 days before catching up, it is likely to take longer for you to recover. If you default on your payments and your mortgage is repossessed or foreclosed, the consequences will be even more severe. Either way, negative marks will fade over time. So guys, your credit score plays a crucial role in your financial life. You need a good credit score to get a rewards credit card. At the same time, your credit score will determine how low your mortgage interest rate will be. A good credit score can also help you in less obvious ways, like when you are getting a new cell phone or car insurance. Increasing your credit score takes time, which is why good behavior is key. While it may take years to build good credit, these 5 steps will definitely help to improve your score fast. With that being said, thank you so much for watching. Please don't forget to let me know in the comments if you got any value from this video. It's 2021, please subscribe, hit the notification bell if you aren't already, and I will see you soon.